day, ladies and gentlemen. Eric Coffin, HRA Advisories. It's the 28th of January, 2019. I'm here today with Mike Williams. He's CEO of Vendetta Mining, a company that HRA follows. We're talking today because this morning before the market opened, Vendetta put out its long-delayed PEA results. It's a preliminary economic assessment of its Pegmont project in Australia. I was generally pretty happy with the numbers. I mean, I'll start out by saying that. I did not have high expectations. I mean, the standalone case for Pegmont's it's always really been there as a, this is a way to show that we can do this on our own. Anyone who's looked at the region realizes that's not the most logical way for anyone to go, that there's actually higher return cases. But that said, after tax, using spot prices, you were using fairly conservative, I thought, fairly conservative metal prices. You were using 8% discount, which I thought was good. Pretty conservative CapEx numbers. I mean, you really weren't getting any favors done on any of that stuff by the engineers. But still, in all, at current spot prices, as per your study, it was about 156 million Australian, 27% IRR after tax. I will note that based on actual spot prices today, because I guess this was probably calculated a week or so ago, based on today's spot prices, the actual after-tax NPV is more like 180 million Australian. And that's purely and simply because lead prices have gone up 3 or 4 cents, because the gearing to the lead price is huge on this thing, because it's a lead, zinc, silver. Lead's very much the most important metal. Now that we've got this out of the way, I think it's important for people to understand that really this study was really kind of sort of meant to be a starting gun. I mean, you've always had a plan for Vendetta when it comes to either transacting on Pegmont and or doing something with it yourself. But for any of those cases, you needed this study and all the background material that goes into it to really pull the trigger on any of these things.
Yeah, I prefer to say long-awaited PEA study, even though it did take longer than we anticipated.
I might have been a little less polite in my alert this morning, but okay.
No, but fair enough. Okay. No, I understand. I understand your frustration. But from the beginning, we realized that, especially in the environment I think we currently exist in, which I think if you do want to transact or if you do want to project finance, your numbers have to be very tight, very exact, and in this part of the mining cycle, call it for what it is, it's a bear market. Yeah. You have to be accurate on what you do, and we wanted a very defendable PEA study, and I think we have delivered that, and we've delivered it in our opinion. It's stress test. The only thing we really think we can do collectively is improve on it. And there's nothing really that would stop us from financing it today if we wanted to. And I think that's key, because the CapEx came in below 200 million, 170 million Australian. Yeah. That's key when you combine that with what the IRR is for a base metal project. And we knew that given the infrastructure. And our internal modeling, we're not that far from where we thought we would be, but we certainly have some room for improvements with I don't think a lot of capital required to do that.
Okay, now that this is out there, let's talk a little bit about what do you see as, relatively simple, near-term things you can do to improve on the numbers that you've got now? Is there 2 or 3 obvious things?
Yeah, look, I think, talking to the technical people and the engineers, for instance, grade. I think by doing some work on the grade, some geostatistical work, which is largely desktop, I think we potentially could see that grade pop up a little bit. And bearing in mind, any increasing grade goes right to the bottom line because it doesn't impact the CapEx. So
now this is based on RC grades from RC drilling, right?
Yeah, largely our RC grades are 10% below the diamond drilling. Now we couldn't bring it into this study, but we need further work. But I think that's doable, and we'll certainly, that's one of the things I think we're going to do relatively quickly, is do some geostatistical work to potentially demonstrate that we can deliver higher grades, and then we'll see how that impacts the bottom line. Okay,
well, I mean, 10% grade improvement's fairly significant, because like you said, it goes right to the bottom line. Based on the CapEx you've laid out, the plant design you've got, is there room to kind of tweak the production rate up a little bit more too?
Yeah, look, I think we're at 3,000 tons per day. We bring that up a little bit per annum. And we can do that, looking at the geology of the ore body. I think we'll do a drill program in Zone 3. Mm-hmm. That might impact that. Once again, largely our capital costs are fixed. That would go right to the bottom line, and and I think that's the key going forward. And the other thing too is if you look at the metal prices, I don't think they're going to go below where we did our base case. And,
right.
If you talk to a lot of the concentrate marketing people, long term you're sort of looking at $1.20 lead zinc, which is certainly significant to where we are. Sustainable prices, and that's a difference that we haven't seen in the industry.
That's 120 for both of them.
Yeah.
Yeah, because you're gearing to the lead prices. Huge, actually.
Right. No, absolutely. There's a higher ratio of lead to zinc. It's 2.3 to 1 initially, especially in the open pit component. As we go down dip, the zinc increases. But this was gear. We wanted to show we had a 10-year mine. We've done that. Yeah. Now we tweak it, and we can add mine life by bringing in Zone 5. We think we need to increase Zone 5 by about 20%, and then that could come into the mine plan. But what that does, it adds ore,
right.
beyond years 10, 11, 12 type of thing.
It doesn't necessarily impact the NPV, but it makes it more saleable. It makes it more desirable as a project.
Yeah, one of the key tenets I think of this study is a company like Vendetta, small junior with $25 million market cap, could put this into production. Now, I'm not saying we want to, but we could. We're capable, and we have the be-all and wherewithal to raise that amount of capital required to do it, through various like off-takes and debt arrangements.
Okay, and let's talk about some of the sort of the near-term. Now that you've got this out, do you want to talk a little bit? I mean, I can lay out what I think they are, but do you want to talk a little bit about what are the different scenarios going forward? I think a lot of shareholders, certainly a lot of my subscribers, already know what I see as the obvious cases. I mean, one of them is, Cannington, which is a South 32 mine, mm-hmm. which is in the same area. The other one is the Osborne mine, also in the same area, owned by Chinova. Keep in mind when you're looking at Pegmont, however the scenario develops, there's any number of ways that rock could end up in either one of those two mills. You're talking about 100 million, 80 million off of CapEx?
Yeah, I would think it would be in that range, which if you look at your MPVs, then you do the math.
It gets added right on, and your IRRs are going north of 50, 60, 70, depending on which one of those cases you're using. So it's a pretty obvious way to go for anybody.
Look, I think the standalone was designed for a couple things. One was to give us a snapshot from where we are. What do we need to do to improve this, to really impact the economics, and we've got that now. Yeah. But it was also geared to give us leverage to a lot of different alternatives. Using one of the local mills in the region, for instance, is one of them. But, we do have now, we could put it into production if we wanted to. Do I think we're going to? Probably not. It doesn't make sense on paper.
And it would be, I know this is a tickler subject. This is a conversation I have with a lot of different companies, and it's always a tickler subject for obvious legal reasons. Confidentiality agreements are, in fact, called confidentiality agreements for a reason.
Yes, they are.
But without saying anything further, would it be fair to say that there are confidentiality agreements in place with more than one party?
Oh, I can neither confirm nor deny the presence of multiple confidentiality agreements.
Okay.
Does that answer your question?
Sort of. I think it gets the point across, yeah.
Yeah, look, no, there has been significant interest in Pegmont as of late, and with what we put out today, I expect to see a little bit more, quite frankly.
Yeah, one thing that I want to touch on, and it's not really PA related, it's more market related. It's not a big secret, I don't think, to a lot of people. It's certainly not a big secret to my readers, I don't think, that there's been a seller in the market the last little while. That seller, it's fairly, it's not well known. It's obvious that it's RCF, Resource Capital Funds, which is one of the biggest shareholders, because they are above 10%, so they have to file insider reports. So
correct. Yeah.
There's no secret there. My understanding from people that I've talked to is a couple of their funds are being repurposed. I'm not sure what that means. I think they're going to turn into debt funds or something else. And over the course of, the next, and it's not a short period, they've got a fair amount of time to do this. They presumably will sell all the holdings in both of these funds and turn them to whatever other thing they're going to do. Have you heard of this from others? I mean, are they picking on you, or are they picking on a bunch of people?
No, I don't think it's germane to Vendetta by any means. Right. I think on some of the Australian holdings are, saying the same thing.
Right.
Now, having said that, our CF allowed us to get Pegmont across the line. Initially, they were the issue is we're probably in their wrong fund. We're in their Fund 6, which is a multi-billion-dollar fund.
Right.
They're putting companies like Vendetta into their exploration opportunities fund, which is more geared to what we're trying to do. So we're kind of orphaned in it. And to your point, and they've made no secret about it, they're reorging. They would like eventually, and eventually is now, to get out. And we were quietly hoping, let us get through PEA, and then we will see what we can do about helping you. But unfortunately, as of the beginning of this year, we've seen a lot of selling coming out of that fund. Now, it is what it is. When people buy our stock, I appreciate it, but they have every right to sell it, and I'll deal with it, and we'll probably find a home for it. But it makes it a little bit more difficult because they've been very transparent, and I'd like to deal with that because I do think it impacted what happened today because it capped us.
I think it definitely did.
So without that, I think we're having a different conversation.
Yeah.
But look, it's temporary. I'll deal with it, and still friends with those guys, but it hasn't been easy.
One thing that a lot of people have asked me about, and it's something you had news out on, I don't know, a month or so ago. And that's the advanced royalty payment.
Right.
The way you restructured it, I believe it's due in about 3 months. Probably ease people a little bit. Yeah. I mean, how is that? Have you got some thoughts on how you're going to deal with that, or?
Yeah, I think the simple answer to your question is sooner than later.
Right.
And I'd like to do it in a way that's as least dilutive to the company as possible. So we're looking at several alternatives on that. One of the things we could do is rejig the royalty, for instance, and there is no royalty for the first 5 years, just the way everything is structured. That's one option. We're looking at several others, but I think it's important now. PEA is out, the final option payment's made. Let's deal with the royalty. Let's get 100%. It just gives me more flexibility to move forward. So, I hope to have something announced, within 60 days on that, maybe sooner.
Okay. And the other thing that's come up recently, because there does seem to definitely be a valuation gap, I guess, between similar companies listed in North America and in Australia. There seems to be more appreciation for small base metal deposits on the ASX. I know you guys have thought about that over the last year or so, but I think you needed the PEA to really be able to think about doing an ASX listing. Yeah,
our thinking was this: in order to appeal to the institutions, and in my mind, they're the real drivers behind the ASX now. They're sort of their super and funds, which have a lot of money to deploy in the sector. We needed to be able to demonstrate some economics through a PEA, or scoping, as the Australians would say, and we've done that now. I think that's one thing that we are going to look at seriously, is doing a dual listing.
Right.
And once again, it could be as soon as Q2, but I don't think later than Q3. If you look at the valuations, give you an example, Heron Resources. Yeah. They were TSX listed when they completed their PEA. They were, similar market cap, 25 million. Now they're in construction, similar deposits, but those guys were ready to go, and they're saying I think 150 million Australian market cap today. Now I'm not saying we're going to go to 150 million, but I think there's a big disconnect between TSX.
There's some built-in appetite in the ASX.
Yeah, and we've been marketing over there when we go over to see the project, and we get we hear this lament. Get an ASX listing, then we can buy you. Right. And I think that'll go a long way with getting where we thought, one thing I've been wrong on is what our valuation would be at this point.
Yeah.
It's about 50% of what I thought we'd be if we had these numbers on a PEA and where we are today. So I think that closes that gap rapidly. And, you know, yeah, that's key for us, and then that gives us lots of flexibility, and certainly if we did want to put it into production, I'm not saying we do,
Yeah.
but if we did, cost of capital is a lot less because your market cap's higher.
Right.
Plus, you know, if someone's interested in us, you look at your market cap value of the ore body, they bake it all in,
Yeah.
and there you go.
Yeah.
So yeah, we're definitely thinking that road, and I think it's good for the shareholders, it's good for us, it should work well.
Okay. I mean, I don't, you know, maybe we sound like a broken record at this point, but the, you know, long delayed PEA is now out. The numbers are decent, but again, really the PEA was always intended to be a fairly harsh, conservative study that would be defensible by the company so that they can start working on the other, you know, what I would consider the more realistic or simply superior value maximization processes. Anyone that follows the stock, we know what those are. There's two mills locally. It doesn't make a lot of sense for there to be three of them. There's any number of ways this ore could end up in either of those two mills, but certainly any of those different variations carry a much higher potential market value, much higher NPV. I think the odds of Mike, now that we can sort of turn him loose with a study in hand and all of these potential suitors or potential deal partners have, you know, here's all your numbers, here's everything you need, here's 10 gigabytes of data. I think now you're in a position to really kind of move things up a notch and go up a couple of gears and speed things up a little bit.
Look, I think it's been de-risked.
Yeah.
I think other people will see that. We've got a financial model. They can put their own numbers in,
yeah,
and come to a conclusion and see what the value is. And that's where we're heading. My challenge is I've got to demonstrate to the market that as well and bring the valuation of the company up concurrently.
Have you got any plans along the lines of, I mean, are you going to kind of step up getting out and talking to people and stuff like that? I mean,
yeah, we've been largely holding off and saying, look, let's keep our powder dry until this PEA is out. So, you know, I know you were frustrated with the delays, and believe me, we were too, because we were kind of hoping we'd have this in the fall, and I would have already addressed the royalty issue, but I think we probably needed the PEA to do it. I can do that now. I think I can get more of an institutional appetite now because it's a quantifiable story,
right,
and as I said, it's de-risked. And, you know, maybe I'm drinking my own Kool-Aid, but I think with a little bit of work, probability is that, you know, we can certainly make some improvements.
Yeah, I think where things stand now after today, the valuation, you know, there's pretty good potential here for, you know, and I'll say it, not him. I think there's pretty good potential here for a transaction, a lot of percentage higher than where it's trading right now. And I think it's also, among other things, it's a good way to play base metals in general. It's quite de-risked, and it's particularly a good way to play lead, and there's very, very few ways to do that. I'm not a bigger fan of lead than anybody else, but one of the nice things about that, it's an orphan metal, so there's not a lot of it coming, and there's not a lot of smelter capacity, so there's room for the lead price to move with not really a lot of movement and demand. And this project is really highly geared to the lead price.
Well, and also don't forget, we're 4.5 hours by truck from the site to a big lead smelter at Mount Isa.
Yeah.
And transportation and base metal, as you know, is key.
Yeah, it's the whole game.
And Cannington is a lead silver mine. It's not a zinc silver, it's lead. So, you know, lead actually, strangely enough, plays into our favor. And if you talk to the concentrate marketing guys this year, it's probably going to be stronger than zinc moving forward. Certainly, what people forget is the TCRCs, which is a key component of, you know, of our study, the costs, and they were a lot higher than we. I think they're.
I was surprised by those numbers. Yeah.
You know, I think they'll, you know, organically the TCRCs will just move down to historic averages, which will impact the numbers significantly. But TCRCs on lead are a lot less than zinc. Right. So you know. People say mining is about making money. It's not about making metal. Yeah. So whatever makes the most money, fine with us. If it's lead, great. And in this case, I think it is. Yeah,
and that's just so if you don't understand the lingo, TCRC, those are the charges that the smelter charges a miner when they deliver concentrate to the smelter. This is what it costs to turn the concentrate into metals. Those shift back and forth through the years depending on supply and demand. As it happens, there's been this big jump in smelter fees just in the last little while. Unusually high, I might say, historically high. And as far as I can tell, this is mainly due to some environmental restrictions in China, which is where a lot of the world's big base metal smelters are. It's probably temporary. I'd expect to see those drop back down. But keep in mind those high, unusually anomalous TCRC numbers are what was used in the PEA. So, you know, timing-wise, that kind of stuck, but it is what it is. But that is something that I think is naturally going to come down and actually improve your numbers a little bit without you having to do anything, really.
Yeah, absolutely. As I say, you know, just to summarize, I think using, I don't want to say worst-case scenarios, but really, let's call it conservative scenarios, as a standalone, this thing should work. Yeah. And we should be able to finance it. Will I think that's how it's going to end up? I don't think so. But, you know...
You wake up screaming, thinking of yourself running a mine for 10 years. Yes, I'm sure.
Exactly.
That's not really how any of us want to go.
Yeah, and look, the ore body's completely open. The more ore will be found there. This is... We made a conscious effort to demonstrate the economics as quickly as possible with a 10-year mine. It's done. And now we can go on to maybe showing, okay, this could be potentially a lot longer mine life with a higher throughput, and maybe if, you know, get lucky a little bit on some drilling and do some geostatistical work, your grade goes up and right to the bottom line.
I mean, all in all, I think this is a story that's probably being beaten up as much as it's going to be. I think you're looking at a, you know, especially given the substantial de-risking that this report has delivered to the market, I think this is a great window for anybody that's interested in base metals, interested in Australia, and interested in Vendetta. And I think we've gone on long enough.
Absolutely.
Thanks for coming by.
Thank you.
Okay.
Good seeing you again.